tax.
You must have heard your parents paying income tax on their incomes from various sources. Truth be told, nobody likes to pay it. But as an earning citizen of a country that allows you to earn, we are by the law of the country required to pay it. Although we may not like to pay tax on our hard-earned income, it is actually a means of contribution towards social welfare. We will talk about this a little later. But first let us discuss the types of different taxes that legally exist in a country, in our case, India.
There are two classifications of taxation: direct and indirect taxation. Direct taxation is what you have to pay on your earnings or incomes, infamously called income tax, and you can see it targets your money directly. Now, to be treated fairly in the country, everyone who earns needs to pay income tax, both individuals and companies alike. For companies, there is a more fancy name for income tax called corporate tax. Let's try to remember. If we have to choose between asset and liability, what do you think tax classifies as, for the taxpayer? Absolutely, it is a liability.
Since different people have different income levels, tax percentage has to be fair and different for different people. Earlier, direct tax also used to be levied upon your inheritance and assets, but they have been abolished now. Most tax is deducted at the source of income itself. For example, like in case of your salaried parents, the income tax is deducted at the time they receive their salary at month end. The tax is deducted from their gross salary by the employer, and the amount of money that comes to their bank is the net salary.
For corporate taxes, they can pay online to the government according to tax payment schedules. Do you remember? We had talked how manufacturers decide the prices of the goods they produce, and that includes all taxes they have to pay. Well, manufacturers have to pay both the direct corporate tax and indirect tax. Indirect tax has already been included in the price of the product, that is the MRP. Indirect taxes target public's money indirectly, since, as you can see, the burden of the indirect tax is finally being borne by the customer who buys the product and pays the MRP or any other price lower than MRP. If we were to define indirect tax, it is a tax levied by the government on goods and services and not on the income, profit or revenue of an individual or corporate, and the burden of this tax can be shifted from one taxpayer to another. Most of you must have heard the hype around GST, or Goods and Services Tax, in 2017 when it was launched. Well, before GST, there existed a lot of different taxes that used to be levied on goods and services, like sales tax, customs duty, service tax, value-added tax, etc. And the complexity of these taxes was further heightened by the fact that the rates of these taxes were different in different states. Too many things tend to create a lot of confusion, and for the government that likes simple things, confusion needed to be cleared fairly. With the implementation of GST, we have already witnessed a number of positive changes in India.
The various taxes, as mentioned above, that were mandatory earlier, are now obsolete, thanks to this new reformed indirect tax. Not just that, GST is making sure the slogan, "One Nation, One Tax, One Market," becomes the reality of our country and not just a dream. GST rates are uniform across all states. The most important justification for GST is that it prevents the cascading effect of taxation, which earlier used to be the case for taxes like the value-added tax or VAT.
A cascading effect is where taxes keep getting added up at every point of supply and distribution, until it is finally delivered to the end customer or consumer, and they have to bear the burden of these taxes, since the indirect tax that businesses pay to government is not from their own income, but from what they collect from the people they sell to. It means they recover this money from the immediate consumer as a part of the selling price, who again recovers it from his immediate consumer as his selling price. The only tax businesses pay to government from their own income is the direct tax.
In case of earlier taxes like the VAT, people used to pay tax on a product or service whose tax was already collected in the price of the product or service. That means the net price would be the original price where tax is already included plus the tax on this price. Can you see what is wrong here? But now, in case of GST, tax is only paid once, and one can file a GST return to claim back from the government the extra he had to pay, which was unnecessary. This extra, that the government returns, is called ITC or input tax credit.
Thus, as you can see, even if a lot of people would not like the new GST, at least it is saving a lot of money that used to be earlier wasted unfairly in the goods and services supply and distribution chain.
For those of us who like definitions and justifications, if we were to justify and define both direct and indirect tax, you could say that both are an obligatory etiquette of gratitude expressed in monetary terms, towards the government and environment.
Because the government runs, funds and commissions economic activities that create jobs from which we receive our incomes, and income helps us live a decent life. It is through direct tax that we are obligatorily expressing our gratitude to the government. In case of indirect tax too, since economic activities based on resources obtained from the environment produce goods and services that we use in our daily lives, it is through the taxation on these goods and services that we are obligatorily expressing our gratitude towards both the government and environment.
It's kind of like paying a service fee to the government for its service of running the country and looking after its citizens.